Preparing for a corporate finance final means looking past the hundreds of isolated formulas in the textbook to find the few recurring, exploitable patterns that actually drive the grading. Success starts with a 4-week revision plan built on the syllabus structure. As you can see on the schedule, every unit, from investment decisions to working capital, carries an identical weight of 20 marks based on 12 classes each. We begin in Unit 1 by calculating the price of risk. The Capital Asset Pricing Model, or CAP, operates like a choice between two job offers, one paying a guaranteed base salary and another based entirely on commission. On the left, the flat line is the risk-free rate. On the right, the market premium spikes, demanding a higher expected return. The CAP formula adds this premium, scaled by beta, to the risk-free rate, calculating the specific required rate of return. Moving to the time value of money, the most frequent errors occurred when students begin calculations before clearly mapping the project timeline. Look at the difference in these two timelines. In an ordinary annuity, cash flows occur at the end of each period, but in an annuity due, those same blocks shift forward to the exact start of each period. That single shift changes the entire present value calculation. To test this, pause the video and calculate the price for a 10-year bond that pays semi-annual coupons at a stated 8% interest rate. In this sequence, the semi-annual payout requires two adjustments before you solve. The 8% interest rate must be halved to 4%, and the 10-year timeline must be doubled to 20 periods. Mastering the time value of money is a matter of mapping these chronological variables on paper before you ever touch a calculator. Unit 2, Capital Budgeting, covers massive corporate investments. Consider the choice between building a custom, in-house data center or outsourcing that infrastructure to a cloud provider. You evaluate these projects using two metrics: net present value, which measures the absolute dollar amount added to the firm, and the internal rate of return, which calculates a project's percentage yield. Often, these two metrics provide conflicting advice. Pause the video now and apply the certainty equivalent approach to adjust the data center's risky cash flows into risk-free equivalents to see which project actually wins. The conflict stems from how each metric treats cash. As this animation shows, NPV assumes you reinvest intermediate cash at the company's steady cost of capital. IRR relies on an unrealistic assumption. It assumes you can continually reinvest that cash at the project's own high percentage rate, causing the valuation to explode upward. When these metrics clash, the absolute cash added to the firm by net present value overrules the percentage figure provided by the internal rate of return. In Unit 3, we look at financing decisions. The weighted average cost of capital, or WACC, represents the minimum return a company must clear to satisfy its investors. Notice how the WACC components stack up in this chart. Because interest is tax-deductible, calculating the true cost of debt requires multiplying the rate by 1 minus the tax rate, a step that physically compresses the cost of borrowing compared to the cost of equity. This borrowing introduces financial leverage. It is distinct from operating leverage, which is driven by fixed factory costs and operational overhead rather than accounting debt. These seesaws visualize the debate on capital structure. The net income approach on the left suggests that adding debt weights tilts the scale to lower your overall cost of capital. However, the net operating income theory on the right argues that increasing debt simply causes equity investors to demand higher returns, keeping the overall valuation perfectly level. Corporate leverage remains a balancing act between maximizing those tax deductions and maintaining enough liquidity to avoid bankruptcy. Units 4 and 5 focus on working capital management, which functions as a constant trade-off between risk and return regarding cash liquidity. This matrix plots liquidity against profitability. An aggressive strategy, like just-in-time manufacturing, moves you into the risky but high-return quadrant. A conservative retail strategy shifts you into the safe but low-return quadrant by tying up capital in buffer inventory. This same tension exists in dividend theory. The debate over whether paying out cash to shareholders creates firm value or is irrelevant to the company's true worth. Success on the exam comes down to anticipating these specific trade-offs. Use this master reference guide to see how these patterns repeat across the syllabus, and you'll be ready for exam day.